Welcome to the introduction of the Investment Readiness Process by Beels. My name is Bjorn Larsson, and I'm going to tell you about why I created the process and who is it for and the purpose. So, who is it for? Well, it's for founders in startups or scale-ups who are focused on growth, but they haven't decided yet on how to finance that growth. They should be open for external venture capital, and best of all is if they haven't revealed a valuation yet. What the investment readiness process does is that it connects your business development process with your financing process. And we illustrate it by connecting them like this. So it really that if you change something in your business plan, that will affect your financing plan. But the investment readiness process is just not only crunching numbers. It's about the dream and the passion that the founders have for their company. And it's so important that the founders have joint expectations on the goal of the company before they attract an investor, so that that investor can also have the joint expectations with the goal with the company. Since we launched the investment readiness process in 2018, now over 90 companies are IRP certified. And you can see a few of them here. Maybe you're the next one. So, who am I then, and why did I create the investment readiness process? Well, as I said, I'm Bjorn Larsson. I'm a serial entrepreneur, and one of the companies that I've co-founded was Zoomability. We made it possible for people who had lost their ability to walk to go out in the forest again, and in the snow and in the sand. It was an amazing product, and we made it really good in the Nordics, and in the United States, the product was really appreciated by war veterans. We were also one of the companies that got prized and got a lot of attention because it was a really good product for the world. And as you can imagine, this was a company that needed a lot of capital. So we raised money 5 times in 5 years. And that was a lot of energy and time from me and the team. So one day we got a bid from one of the big global companies in our business. And we were really happy. But at the negotiations, we weren't part of that because me and the CEO, we had so-called golden handcuffs. We were supposed to be in the new company for 3 years. So when we were waiting in our office with the champagne for the final decision from their board, the call came too early, and the call was, well, they won't buy us. And I remember putting back the champagne, going back home, and tears ran down my cheeks because I've been working so hard for this exit. But then a little bit later, when I coming up to my house, I felt a relief, and I couldn't imagine, why is this happening to me? Why am I feeling happy? And I realized it was because of the golden handcuffs. I hadn't imagined working for them for 3 years. That wasn't part of my plan. A few years later, the company was listed on a stock exchange and I could sell my shares. So all good. But I got really curious on how investors think when they invest. So I started to learn about that, taking training and reading all the literature I could find. And I was really inspired by Jason Calacanis, one of the best business and investor angels in the United States. And that inspired me to give back because I realized that as an entrepreneur, I didn't know about all these questions that investors had. I answered them as good as I could. So what I did then is that I structured the investment readiness process so that you as a founder can answer their questions. And I will tell you what the 5 crucial investment questions are. How much money will this venture need now and over time? What will you do with my money? And how does that create value? How and when will I get my money back? What is the potential payoff for me as an investor? And what is the risk versus the potential payoff? From a pedagogical perspective, I decided to make the investment readiness process something that could really prepare a founder for investors' expectations. So let's start with the risk. It is statistically so that 1 out of 10 succeed. And that we're talking about startups. In the United States, a startup is a company that actually have started to sell. And 1 out of 10 succeed. What is success? Well, in this term, from an investor's perspective, it's only when you give me a really good payoff. So let's look at an example. Say that you want to invest 1.5 million euros in startups. and you decide to invest in 10 companies because you know that 1 out of 10 succeed. So you invest 100,000 euros in each, and then all of the companies come back and say, we need a second round. So I decide to focus on 5 of the companies that I believe in most, and I invest 100,000 in them as well. But what happens to those who didn't get my money in the second round? Well, they might need to find new investors to invest in the new round. And those investors, they will ask, do you have investor on board? Yes, we do. Why don't they invest in this? Because they took more risk than us. It's a tricky situation. I've been there. It's possible to solve, but it's also possible to avoid. So that's something that you can learn from the investment readiness process, how to do that. Let's continue the example. A few years later, one of the companies is sold and one of them is on the stock exchange. So let's say that one gives me 5 times the return and one is a so-called home run. It gives me 10 times the return. In total, I will have 3 million euros after 5 to 7 years, perhaps. That's good. But remember this, all the companies that I looked up in the beginning, maybe 100, all of the companies need to show a potential return of 10 times the money. Otherwise, the mathematics won't even work statistically. But you as founders then, well, you have a dilemma too, because you want to be focused on your product and market, and we all want you to do that. But when raising money, you need to focus in the complete opposite direction. And attracting angels is probably what you will do in the beginning, and they are a market too. They have different preferences and requirements, but they all want to make a good return on their money. So when you pitch, don't focus too much on your own product and the technology. Try to think about the investor's perspective and answer the 5 crucial questions that we talked about. And you should, in this process, be able to describe your investment offer to the investors. So who are the investors then? And what are the differences? Well, there's a lot of differences, as I said, but let's look at 4 examples. So first of all, you can read here about Valorud Ventures and a friend of mine, Eric Birenius. So you can see that the Valeruds, they are working with you in operations. That's quite rare, but that's their way of reducing risk. And they were one of the first investing in Klarna. They're really good investors. Eric Birenius, he's investing in a lot of companies, so he cannot put that much time into each company. So what's good for you? And what kind of founder are you? And what kind of investor do you want to have? Let me give you 2 more examples. This is Lennart Olsson from Stuaf and Ann Grevelius from Bullhound. As you see, Stuaf is looking for deep tech companies, maybe with a 10-year advantage due to a patent or so. But they know that they will change the team because they need people with more commercial abilities. While Bullhound is looking for the team, and they believe that with the best team, that's what makes a company fly. Let's go back to you as founders. I've made a combination of several models in one slide, and let's go and look at it. I call it the risk and value return model. And in the lower section, you can see the development stages of any startup, from the idea and proof of concept through proof of business and mature of exit. On the left side, you can see what kind of venture capital you can find when you are in a different stage. What actually reduces risk is that you begin to sell. When you get traction on the market, that also increases the value in the company. And as you can see, I've made the value symbolically as a staircase, and it's to show you the equity rounds. So let's say in the beginning you make a round, and that gives you money to go from proof of tech to pre-proof of business, and that is called the runway. The runway is possible to do because you raised money, and these are the average amount of money that a company can raise in the Nordics. So let's say you're a pre-proof of business and you make a round of 1 million euros, and that gives you the runway to get to proof of business. But remember what the investor said. A company who's a startup is 1 out of 10 succeed. So when you're a startup, you need to show 10 times the return. And if someone wants to invest in you even earlier, well, they might expect 20 or 50 times return. And then finally, maybe you know the names of the rounds. It's called pre-seed, seed, A series, and B series. If they invest before the pre-seed, it's because they just love you and the product. But a venture capital, on the other hand, they're not investing with their heart. They got skilled people working with this every day. So now when you raise that kind of money, it's not private persons anymore. So you really need to have the metrics. And I met 3 VCs the other week, and they all said that if they want to invest, they want to see companies with a high monthly recurrent revenue, and that they have a growth of perhaps 20% and a net profit of 20%, and that they've had that for at least 6 months. So, raising A series, you really need to have your metrics. And how does most founders think? Well, often I hear that they want to have as high pre-money valuation in the first round that they possibly can because they don't want to lose control. I know. I said the same thing. And I don't say that it's wrong, but remember this, if you push up the pre-money valuation in the first round and you're pre-proof of business and you then have investors expecting 20 times that money, can you really reach that kind of return for them? So what about this control thing? Well, as long as the company is cash flow negative, so you're burning money, you're really dependent on the investor. So it doesn't matter if he or she has 5% of the company. As long as you need their money, they're in control. It is important for you as founders to understand how much capital do you need now and over time, and when will you be cash flow positive? Those are some of the questions that you will answer in the investment readiness process. Let's have a look at it. The process is built up with 5 meetings with an IRP certified instructor. You meet online or in real life, and you, as founders, have 8 assignments to do between the meetings. The full investment readiness process is about 5 weeks because you have 1 week in between each meeting. And you document all your answers in the IRP tool, which is a web-based tool. When you've completed your investment readiness process successfully, you will be IRP certified. You will have this stamp and you can use it to show investors that you prepared well for their investment. So what are the results from an IRP? You will be able to show investors what really drives value in your company, what the milestones are to reach those values, and your strategic roadmap to reach the milestones. You will also be able to show them a financial forecast, a valuation model for a future potential exit for them as investors. And you will also have this in an investment offer in your pitch. By doing this, you will save time and energy when doing your equity rounds. You will be well prepared and have a good confidence when meeting with investors. Sometimes I do this. Investors are in a good negotiation position because they have the money, they have the time, and they have the knowledge. I want you to be leveled out on the knowledge perspective. Finally, you will be able to show them a relevant valuation of your company and a potential return so that your investors have the same expectations as you on your company. Thank you for watching the introduction to the investment readiness process by Beels. If you're a founder and you realize that this is important to you, I can tell you, we also have the 5 crucial questions that you should ask the investors. So, contact one of our IRP certified instructors today and find out more.